No, I am actually, I'm glad you raised that because this is a really notable thing that's going on in the current market. You have, the S&P 500, kind of touching all-time highs, but the breadth of the market, breadth of the U.S. market is not good. As you note, the Nasdaq has been somewhat more challenged. The Russell has been a lot more challenged off the highs. You're seeing a market that's being led by a narrower number of stocks. And I do think that that's something of a warning sign heading into summer. We do expect a choppier, more range-bound market over the summer. I think you're leaving some of the favorable effects that you had, that the market's been able to enjoy in April and before. And I do think this kind of narrowing breadth is a sign that reopening is not straightforward, that many companies will benefit from it, but others will be hurt by the fact that costs are rising and reopening is not necessarily easy.
Andrew, by and large, we've had a market that's been going up in this recovery phase, not a huge shock in terms of a plunge south at this stage. But, we've had this renewed focus from Lyle Brainard about the exposures to hedge funds at this stage, and we're still raking over the coals of Archegos, 50 billion in leverage extended to one particular client. And as we heard yesterday from Brainard saying that there's limited visibility for the Fed into these hedge fund leverage across the system, it feels like everybody's patting the banks on the back for emerging from this crisis and not having a disaster like the last financial crisis, that they're in such good health because of all this regulation that has been applied. It's not really the case, is it? If one single name exposure can have such an enormous impact on some banks and their quarterly numbers, perhaps there's deeper risk than the market is assessing at this point.
Well, I do think questions about risk management will remain evergreen. I think it's right that the Fed is focused on risks of a variety in a variety of forms to the banking sector. I still think something that is interesting is this: if we think back to the markets of 2004, 2005, back before the Great Recession. Those were times when you started to see a lot of leverage work its way into the financial product side of the market. You started to see, significant kind of leveraging of other assets, CDOs, the like. And we haven't really seen that trend yet. So yes, kind of asset prices have gone up, but in terms of the application of leverage into those markets, that has still remained somewhat more restrained. So I guess what I'm trying to say is, I do think the Fed is right to kind of think about, a wide variety of risks. I think a lot of investors probably will think, as you head into the summer, what is my liquidity position? I'm heading into a less liquid time of the year anyway. I need to be kind of mindful of that, and that could lead to some reduction of net exposures. But I think in terms of the structure of the market and the amount of leverage that's on the product side, that still feels a lot different from the prior cycle.